welcome everybody this afternoon to our McAllen Society Power Lunch. If it's your first time, we've had these power lunches over probably the last year. We sort of offer them on a quarterly basis, but there's been such a great response and interest in a lot of our subject matters that people have asked us to offer more. So we had one last month, and we're welcoming now this wonderful PNC group that is joining us to help me share information about the mega bill, which we've been getting lots of questions on. If you don't know who I am, my name is Susan Damiani. I am the director of gift planning, and I'm also the director of the McAllen Society, which is our legacy society. So I want to make sure that you get as much information as possible. So I'm going to first introduce our first speaker. His name is Robert, and I hope I say this right, DiCostanzo. Did I say that correctly, Robert? Robert is a St. John's alum from the business school, as you've been hearing. We believe he graduated 1995, and we called it back then the College of Business Administration. Robert is Senior Vice President and the Senior Investment Advisor at PNC. He has nearly 2 decades of experience asking high net worth, ultra net worth, endowment and foundation clients. And he has been so helpful with putting together this team of experts for us today, and I just want to thank you and thank you for your support to Alma Mater. So Robert is going to be our moderator, and I'm going to turn it over to him now so he can introduce the rest of his team. Thank you, Robert.
Oh, thank you, and thank you, Susan, and thank you everyone for joining us today. As Susan indicated, my name is Robert DiCostanzo. I serve as a Senior Investment Advisor for PNC, but more specifically, the private bank. And in my role, I manage assets for our private bank clients on a discretionary basis. And we take a really grassroots approach with our clients, getting to know who they are, what they're seeking, what their goals are. And those goals could be anything from cash flow to legacy, and also knowing what their risk tolerance is. And then from there, I design and manage portfolios aimed at growing wealth or providing liquidity and supporting legacy planning, all aligned with each client's unique objectives. As Susan also mentioned, I'm a proud St. John alumnus from the 90s. I also have the unique distinction of being part of the last graduating class to wear the old Redmond ring. So I wear that proudly. It was a real changing of the guard, if you will. And that theme of transition seems especially relevant today as we stand here on the cusp of significant changes in tax law. And, some provisions have been made permanent, others have been phased out, and several new rules will impact individual filers, business owners, estate planning strategies. And we'll also touch on charitable giving, an area that particularly is meaningful for many of you. But joining me today, as Susan also mentioned, is John Petrosino. John is our senior wealth strategist at PNC Private Bank. John, I could say, is one of the most respected professionals in our market, guiding clients through estate planning with exceptional insight. And he brings over 15 years of legal experience as well as an attorney, primarily working in the private practice. And, while I'd like to think this is really just a fluid conversation. We encourage participation throughout. We'll allocate time for Q&A at the end, but please don't hesitate to post questions in the message board. We'll address them as we go. With that, I'll hand things over to John to dive into the details. Take it away, John.
Thanks, Rob. Thanks, Susan, for the introductions. Happy to be here. like Rob said, spent most of my career in trust and estate planning, following up on tax provisions as they come out. Obviously, the biggest one being this One Big Beautiful Bill Act. I'm going to talk to you today about a lot of provisions, what's in the act, what hasn't changed, what's new, and then there's some specific focus on business, education, and charitable strategies that I'd all like to get into. And then, how does it all impact us on this call? And there's 18 people on this call. I hope we can make this interactive. So if something pops up, please write it in the chat, raise your hand, or just unmute yourself and blurt it out. I'm happy to touch on things as they come up. That would make this less of a one-way presentation. I think it would be best for all. I do have to admit before I get into it that I am a bit of the enemy. I went to 2 schools in the Big East that were not named St. John's, and I hope that doesn't make you not listen to a word I have to say. But I'm old enough to have gone to Boston College when it was still in the Big East. It hasn't been in quite some time. And I also went to law school at Villanova, which I'm sure you hate. So please, again, don't hold it against me. But I'd like to start by saying the biggest takeaway from this whole thing is that most of the provisions that were made temporary in the Tax Cuts and Jobs Act back in 2017, 2018 were made permanent by this act. So, what Trump did back then, he said, you know what, 8 years have passed, I'm making them permanent. Now, what is permanent in tax law? That could be forever, or that could be, when there's a new president in 2 years, things are subject to change again. So permanent is somewhat of a loose term, but until some legislative changes are made, this is what's going to be in the act, or in the law, I should say. The biggest thing, the lowered rates that were done back in about every tax bracket was lowered between 1% and 4% on the rates, which is great. Everyone likes paying less tax. The top bracket went from 39.8% to 37%. I'm not going to list all the brackets. One thing I did want to touch on was, and which isn't necessarily a change in the act, but I don't hear a lot of tax professionals talking about it, is that for a married couple at $394,000, that's a point where you jump from a 24% tax bracket all the way up to a 32% bracket, an 8% jump. So if you're thinking about your own finances, and if you're at that threshold and you might want to push some income off or pull some income in for a given year, that's a pretty big difference. It's the biggest of all the tax bracket jumps from 24 to 32% at that $394,000 mark. The increase in the standard deduction made it permanent. This year it's going to be $31,500 for a married couple. It used to be, if the law were to have sunset and they didn't make this permanent, would have gone all the way back to $12,700. So that's a big change. The child tax credit for families, for 2025, the new bill kept that, actually increased it by another $200. So for every child you have, you get a $2,200 tax credit. Under the old regime, that was only a $1,000 credit. So again, significant. And a credit, again, is a dollar for dollar deduction from your taxes, not necessarily, dollar for dollar reduction in your taxes, as opposed to a deduction where you're just reducing your tax base that you apply your tax rate to. So more important to get a credit. Qualified business income deduction is section 199A. If you have a business, now that's a pass-through entity, not a C corporation. They tried to equalize the rate changes that were made permanent in 2018. They said C corps were taxed at 35%. Now they're taxed at 21%. Well, that's not fair. What about all the other businesses? We're going to pay tax at the same old rates. Well, no, because of this qualified business income deduction, they get a 20% decrease in their taxable income. So if your business made $200,000 in the year, now you get a $40,000 deduction, and that now is permanent. We had it for the last 8 years. It's permanent. There were a bunch of deductions, minor deductions that were itemized, moving expenses, employee business expenses. You used to be able to deduct your accountant's fees and your some legal fees on your tax returns. In 2018, Trump's bill eliminated those. Now they're permanently eliminated. One of my favorite topics, I could probably talk here for an hour on estate and gift taxes alone, but there's a $15 million exemption amount that is now permanent. It was 13.99 million last year. We weren't sure if that was going to be cut in half if nothing was changed. Well, we've made it permanent now. It's 15 million this year and then indexed for inflation going forward. What does that mean? I heard last month's talk, so you're probably familiar with it. That means if you have over $15 million, every dollar over that will get taxed at 40%. So if you die worth 20 million, you're $5 million over that exemption, you're going to pay $2 million in tax. Pretty hefty bill. There's a lot of planning we can do around that if you hit those thresholds. Now, if you're a married couple, each of you gets 15 million. So that's 30 million per couple, and that's portable. So as long as you are under that $30 million when the first spouse died, they can use the first spouse's 15 million at the second death.
Hey, John.
Yeah, sure.
Quick question for you. So can you talk about what this would have looked like if the numbers had reverted and set back to numbers that were not as favorable in terms of lifetime gifting?
Sure. So that 15 or it was 13.99 million technically per person. If the bill didn't get passed, that was going to get cut in half. So it was going to be about 7 million per person. And that using that same example, if you died worth 20 million, instead of only paying 2 million in tax, now you're $13 million over the threshold, and 40% of that number is just over $5 million. So that's a significant increase from $2 million in tax. That's a big one. Now it doesn't affect many of us, but those of us that it does affect is a big tax. And then there's also the annual gift exclusion, which some of us are familiar with, but gets a little complex. That's the amount of money we can give each year to any individual without even eating into our $15 million that we have to give. And that amount is $19,000 a year. So we can give I can give $19,000 to 10 different people without using any of my $15 million gift tax exemption. And of course, that amount can be gift split if you're married. So it could be really, if you're a married couple, $38,000 per person, without eating into that number. One big thing too with the state and gift tax planning is generation skipping tax. What's the generation skipping tax? That's when the IRS people got smart, they said, hey, you know what, why would I let someone escape that estate tax and just give to a grandchild or a great-grandchild and only pay one set of taxes? But no, they caught up and they said, no, we're going to tax you at every generational level. And that's what the generation skipping tax tries to do. It eliminates your ability to skip generations and not pay that estate tax at every level. The key thing that is there's no portability. So if you're worth over $15 million and but not over $30 million. So you might not want to do planning. You might just want to give everything to your spouse, let your spouse give it to the children. If you want to start some type of a generation skipping trust, you would have to do it at the first spouse. So there, you'd have to set up a $15 million trust at the first spouse's death to save his $15 million of exemption or her $15 million of exemption. I don't want to bore you with more generation skipping tax conversation. So let's move on to the AMT, because that's so much more fun. The increased AMT exemptions have been made permanent as well. This is a big change too, because back in 2018, the exemption, the phase out amount for people that might have had to start paying AMT was as low as $160,000 per married couple, and now it's up to $1.2 million. So a lot less people are paying the alternative minimum tax than they were, and it will be continued that way. One of the other things made permanent is mortgage interest. It's limited to the first $750,000. Under the old regime, you got to deduct all of your primary residence and another residence, the mortgage interest. Now you're limited to that first $750,000 of loan. So what the interest on that? So if you have a loan worth that's over $750,000, you're not going to be able to deduct all of the interest. And finally, one of the things that was made permanent is the casualty losses have been changed. It used to be able to deduct any type of fire, theft, any major loss that was a casualty from your tax return above a certain threshold. 2018, they limited to that to only federally declared disaster areas, and now that's another permanent provision. More excitingly are the new provisions. A lot of us talked about state and local tax is now raised from 40,000 instead of being limited to 10,000. I please invite some questions if they're along the way too, because I feel like I'm just preaching at this point. But the state and local tax is now raised to 40,000, but it's only good to 2029. That's not a permanent raise. And it goes up 1%. So it's 40,000, 41,000 for 1% each year till 2029. So it does raise a little bit, but it goes away at 2029 unless there's a change. There's some interesting strategies that we could use to stack that. If that's something important to you, and there are certain other income tax provisions, a lot of people are discussing the use of trusts, because as an individual or a married couple, you're only allowed that 40,000. But let's say you had a $10 million account, and it wasn't just owned by you and your spouse. You set up trusts so that, you set up 4 trusts. So you owned a piece, 4 different other trusts own 2 million each. So that totals 10 million. You could actually avoid that limitation and let the trusts capture some of that SALT tax in those trusts. So like let's put some numbers to it. If a 10 million, if you had it invested at PNC and we were earning you an amazing 10% a year on your money, that $10 million account would have $1 million of income. If you were in a high tax bracket state like New York or New Jersey, you might be paying 10% on that million in state income tax. That would be $100,000 of state income tax. If you were, just filed your return as a married couple, you'd be limited to $40,000 of that $100,000, and you wouldn't be able to take $60,000 of deduction. If you use some trust planning, you could actually capture all of that $100,000 because each entity would be allowed $40,000. So I mean, it does take obviously some setup fees with lawyers and accountants and other things. So depending on the asset, depending on the net worth, these are the things that you can consider to take advantage of, because it might be worth it if the dollar amount was high enough.
Hey, John,
Tip income.
just
Yeah.
want to throw in that, these are obviously issues in many cases that are complex enough where we have to lean on other people. And, for all of us, it's, leaning on your tax advisor, among other people, or your estate planning attorney. When I think about the state and local income tax or the SALT tax, I mean, that obviously hits a big swath of people because we live in, let's say, not the most cost-friendly environments here, living in New Jersey, in my case, or New York, like most of you. So, these are real issues. These are issues that will certainly make a difference to our bottom line because of how high we are taxed in, both of these jurisdictions. So I don't want anyone to lose sight of that. These are real things, and they're going to impact a lot of people. I think it had a really unintended consequence when it went away. There will be a lot of other jurisdictions around the country will say, well, it's not fair because we're going to capitalize the most. But I also think that in many cases we were, in effect, penalized the most. And it just didn't hit people in the upper tax bracket, it hit people, in other tax brackets as well. Hey, John, can you just touch upon this one? Might seem unbelievable, but it's kind of near and dear to my heart. Maybe just touch on it. I have a daughter who works. I have a lot of kids, but one of them works as an esthetician. So a lot of her income comes from tips. So could you just touch on the tip income or the provision there? Because I know that's kind of a new provision.
Sure. No, thanks, Rob. And I'm sure that's a lot of us on this call is, none of us probably work on tips, but we all probably have a relative or someone who does. And one of the new provisions, I know President was trying to eliminate tip income, eliminate Social Security, making grandiose comments because he never does that. But he was able to reduce tip income, and now people that earn tips have a $25,000 deduction that phases out at $150,000. What does that mean? The first $25,000 of their tip income will not be taxed, as long as they make under $150,000. Now it starts to phase out, and eventually at a point it gets eliminated altogether. So if they're high earners, that could be eliminated. And again, and for joint couples, that phase out's $300,000. So, if one person in a couple works on tips, that's certainly an advantage for them. Same thing with overtime. We've heard about overtime promises. The similar type deduction there, but it's not $25,000, it's $12,500. 25,000 for joint returns. We heard a lot about Social Security. While there actually was zero change in the way Social Security is taxed, I'll say that again, there was no change in Social Security tax. There is something that's new, and that's a $6,000 deduction that seniors could get as long as they are under 75,000, and it will be completely eliminated at $175,000 worth of income. So seniors did get a little benefit there if you're under that $175,000 mark, and the full $6,000 at 75. It's for married couples. It's 150 to 250 is the phase out range, but that's something that's nice for seniors. Another interesting provision that's never been seen before is an introduction of Trump accounts. And I'm not sure how popular or well known this is, but what's going to happen is every child born between 2025 and 2028 will have the opportunity, people will get an opportunity to get $1,000 refund on their tax returns for having this child. And that $1,000 is almost like a pre-tax contribution to a Roth IRA. Excuse me, not pre-tax, but a pre-tax contribution to an IRA, not Roth IRA. And it's odd. It's something brand new. We've never really seen anything like this, but it's essentially a free $1,000 gift from the government to these accounts. Now, once this account is created, with this $1,000, people can contribute their earnings and continue contribution, but the additional contributions are treated as Roth contributions. And what does that mean? They're made with after-tax dollars, and they'll get tax deferral until the account holder, or the account, excuse me, not the account holder, but the child ultimately turns 18. So when the account owner turns 18, they could start taking distributions from these accounts. I'm not so sure how advantageous they are. I think based on the rules in place, contributions to regular owned Roth accounts might still be better, but you do still get the free first $1,000. So there's certainly a benefit there for being born in the next 4 years. Other
So Jen,
provisions.
I don't want to downplay some of the other, big provisions, and maybe you just kind of touch on the business provisions, because I know that might be impactful to some of our audience. But what I really want to get to at some point is the charitable provisions. I think that will be, somewhat more personable to our audience. So I don't want to overlook that. And we can certainly come back to the business provisions. And I also know there's some educational provisions. So maybe you want to touch upon the business provisions, the educational provisions, and we can kind of circle back at the end if we have time.
I think that's fair, Rob. There have been significant changes as it relates to charitable provision changes. First of all, in the Tax Cuts and Jobs Act over the last 8 years, we've had this ability to deduct $300 without having to itemize our deductions. So we, no matter what, if we were which way we went, we could always deduct $300 of charitable. That amount has increased to $1,000, $2,000 for a married couple. So that's a significant change. There's $1,700 more for a married couple that they could deduct without even having to itemize their deductions. Another change. It used to be only to be able to give 50% if it was a cash gift of your adjusted gross income. Now that's been upped to 60%. I'm not sure how many of us are giving away 60% of our adjusted gross income, but it certainly is a nice bump up for those with maybe smaller amounts of income in their later years that have large accounts. Another one that kind of hurts charitable deductions, Elizabeth, is now there's going to be a 0.5% floor on charitable deductions. What does that mean? So if you make, let's say, $300,000 in a year, that's your AGI for this example, and you donate $50,000. The first 0.5% of your donation is not going to be deductible. So that would be about $2,500. You wouldn't be able to deduct at all. You would only be able to deduct that $47,500 if you were making a $50,000 contribution. And that floor also extends to corporations. Corporations have a full 1% floor, so there is this limitation now. You have to deduct over a certain amount, or you have to give over this certain amount to get the deduction. Probably the biggest change, though, is now if you're itemizing your deductions and you're in the top tax bracket, so if you're in that 37% bracket, you're not going to get a 37% deduction on your income. The maximum deduction you can get is limited to 35%. So you lose 2% if you're in that top bracket. One thing that you could do to avoid that is give this year. 2025, you still get the full 37%. If you guys are in the top bracket, I would highly, encourage you to bunch your gifts this year. So whatever you thought you were going to make next year, push that into this year and save that 2% of a deduction. From an education standpoint, they've expanded 529 plans. Now 529 plans can not only be used for college, but can be used for $10,000 of elementary coverage or middle school, private school coverage per year. That's a nice expansion. Another one that has yet to be fully vetted out, which I think is probably the best one for education and charitable deductions, is people are going to, starting in 2026 or 2027, get a dollar-for-dollar tax credit up to $1,700 to make towards certain scholarship granting organizations. Now, this is great because instead of paying $1,700 in tax, you could take that tax that you would have paid and donate it to these scholarship granting organizations of your choice. What's not so great is that we don't really know what that definition is yet. The federal government left it up to the states. So now the states have to adopt this program and then kind of figure out what these and create these scholarship granting organizations. So we can't do this yet, but it looks like something that's if we like making gifts. This is something nice on the horizon that will essentially not be a charitable deduction, but actually a charitable credit for up to $1,700. One other thing I want to talk about, which wasn't the One Big Beautiful Bill, but it was the FAFSA Simplification Act, which started last year. It went into effect for this 2024-2025 school year, or the past 2024. But not too many people are talking about it because I would get questions my whole career relating to 529 plans. I'm the grandparent. Does it make more sense for me to start a 529 plan, or should my son or daughter start the 529 plan for their child? This provision kind of eliminated some complexities, we'll say, as it relates to that. Under the old rule, if a parent made had a 529 plan for a child, and then that child went to fill out a FAFSA application, a small percentage of that account would count as the kid's assets in determining what was available to him for grant money or other funds, while a grandparent-owned account would not count at all. So there was an advantage in that sense to have grandparents owning the accounts. But when a child took a distribution from a 529 plan to pay the expenses for that year from a parent account, it would not count at all towards next year's FAFSA application and the year after's applying for these same grants. Whereas if a grandparent owned the account, that distribution would count as 50% be an available asset to the child or grandchild in that situation, which was a major hit and might significantly affect the application. So we would come up with complex planning strategies where we'd have 2 529s, one owned by the parent, one owned by the grandparent, and have the first 2 years be paid by the parent's account so as to not affect any future accounts, and then the last 2 years owned by taken from the grandparent's account to pay for those last 2 years. So really wouldn't affect it as minimal as possible. But now with this change, they've eliminated that rule that the distribution from the grandparents' accounts counts as 50%. It counts as 0. So there actually is under today's rule a slight advantage of having a grandparent own the account for FAFSA purposes.
God, I think that's great. That's and thanks for going into some detail there. I think that obviously affects a lot of us, those with children, obviously in school, and based on what you said, it's not just some of the provisions also cover not just college expenses, but also elementary expenses. I don't know if you touched on that yet, but also I think we kind of like to focus on you gave us a lot of information here. We touched on a lot of provisions, those that were potentially to be sunsetted, those that will continue. There's some of the new provisions. So, and you also mentioned one of the takeaways about taking advantage of that higher charitable deduction. But what are some of the other takeaways from these provisions that would be, obviously beneficial to our audience and then just clients in general?
Yeah, I mean, that's probably the biggest planning takeaways, just basic from this new act. Because I have a couple other things I wanted to touch on real fast too. It is definitely bunch charitable deductions this year while you can. It's a little late maybe to create all kinds of trust, but trust planning for charitable deductions is always preferred, because if any of you have St. John's, let's say in your will or in some type of trust document where St. John's is going to get a benefit at death, I'd highly encourage everyone to change that. So you create a charitable remainder trust where not only will you get any type of the benefit at death, but the trust, if you gave it to the trust, you could reserve a right to that property and still utilize some of the assets during your life, but get an income tax benefit for it. Because if you leave it at death, you lose the income tax benefit. Whereas a charitable remainder trust will do the same thing. It won't give the asset to St. John's or any other charity until death, but you at least get some income tax benefit for your gift. And I'm all about charitable giving, but if you're going to do so, I say just do it in the most tax efficient way possible. And I think people lose out on some of the tax efficiencies when they wait to giving to their death. That's one thing I would say, and I say that in the sense that where if you did it this year, now you're getting an extra 2%. So if you could make that gift to a remainder trust in the next month and a half, that would be ideal, because now you're being even more efficient, saving that 2%. The other thing is the stacking. I talked about stacking with, using trust to take advantage of more SALT deductions. Now kind of circling back to the business side of things, one of the biggest expansions of the One Big Beautiful Bill Act, a few of them have to do with businesses. And C corporations, I don't know how many people are familiar with Section 1202 or qualified small business stock, but if you have a C corporation, and I forget the exact year in the 90s, but maybe it was created after 93, I want to say, and held it for 5 years, you get a significant reduction in your capital gains tax. That you could save up to $10 million. Now, it has to be a qualified small business stock. So what the One Big Beautiful Bill did was expand the definition of qualified small business stock. It's now any stock that of a company where the gross assets are under $75 million of total gross assets. It used to be only $50 million. And it also expanded that $10 million of exemption to $15 million of exemption. But what you can do with stacking is, instead of owning the business in your own name, or you and your spouse, in getting 15 million and 50 million, separate it into different trusts. Take advantage of 50 million, 50 million, 50 million. Now, you could stack it and eliminate almost the entire capital gain, as long as each one of those entities held it for 5 years. So there's a lot you can do with stacking and using trusts because of this bill. Another business provision too, not to dart around, but 100% bonus depreciation for equipment. Used to just be for capital assets and things. Now for major equipment or any other tangible personal property, really, you can take 100% and expense it in year one. So what's that doing? A lot of major corporations are going out and spending money. Definitely an economy booster, that one. R&D, another, instead of, it used to be you have to capitalize R&D expenses over 5 or 15 years, depending on if it was a domestic or foreign expense. Now you can do it in year one. So there's been a lot of economy boosters to this bill that hopefully will play out over the next couple of years. That's pretty much what I've got for you. I can go into opportunity zones. We did extend the opportunity zones. I know everyone knows what an opportunity zone is, but what that is really, if you hold property that's been designated a qualified opportunity zone and you hold it for 10 years, any increase will not have a capital gains tax. As an investment person, I would cautiously advise investing in qualified opportunity zones, just because over the last 8 years, the tax benefits seem to have not been worth the investment performance on some of these assets. So before you make some of those kind of, this is a great investment, I'm going to save some taxes, just don't let the tax tail wag the dog. But that's it. Enough of me talking. I'd love to hear if anyone has any questions.
I was just going to say that. Thank you, Robert and John. Thank you for that detailed outline on this bill. You gave us a lot of information. How you keep it all in your head, I don't know. God bless you. But we'd, like John was saying, we'd love to hear from you. Is there any questions anyone has for Robert or John? Do not feel like they're silly or whatever. You never know. You throw out the question, everybody can learn from each other. I see everybody has their mics off, but anybody want to turn off their mics? Any questions? I guess I have one question. I know we keep talking about married couples, but
it looks like Maria has her hand up.
Is there? Oh, okay. I didn't see that.
Hi, good morning. I have a question about the SALT tax deduction. So does this apply to real estate taxes on a primary home, a second home, state income taxes? Can you clarify what that applies to, please?
Yes, so all local and state. So yes, it would apply to real estate taxes, any taxes you pay to the state of New York or the state of New Jersey, or any taxes you pay to New York City.
Thank you.
Yep. No, thank you. Being brave and asking the first question.
Yes, thank you. Good question. I would just say we keep talking about married couples. I don't know if there's a lot of single professional women or men on this call, but anything as a single professional person, anything we could take advantage of with this mega bill?
Well, specifically, I don't know if I'd say there's anything specific to single person that it's not of it. You know, the thing is with single people, thresholds are lower. Sometimes the benefits are cut in half or doubled depending on whether you're single versus married. You certainly have a lot less headaches staying single than being.
That's good to hear.
But no, I really can't come up with something that I'd say, yeah, it's better to be single for this, or because you are single, you could take advantage
Right.
of this. I'll keep thinking about that though.
Mhm. Thanks.
You know, Susan, you mentioned something earlier. You said that, how does John or I, or mainly John, keep all this stuff in his head? And I think it's a really good question. I mean, there's some complexity to these changes, but these are the type of conversations that are really a precursor to even, getting to know our clients, because they are impactful to so many of them, especially with our clientele that, generally speaking, are very high net worth individuals.
Mhm.
So this is part of our deliverable as a firm and as part of the private bank. So it's a good it's a good comment you make, and I just wanted to really opine on that because these are daily conversations with our clients.
All right, thank you. I know Steve Conroy, you had your hand raised. Please.
Hi, how you doing, Susan? Hi,
Hi.
John. Hi, Robert. I have a
Steve.
question. In the state of New York, what would be the estate tax on a trust valued about $6 million, or is there any tax on that?
So it's a good question, and like any good lawyer, I'm going to say the answer depends. Is the trust a revocable trust, or is it
It's
irrevocable?
now it's irrevocable because the grantor has passed away.
Oh,
Okay. So see that it depends a little bit on the terms of the trust, of whether it's pulled back into the decedent's estate or not. If it's a revocable trust, let's just say that, and it is includable in this decedent's estate, you are under the New York estate tax threshold, one of the few states that does still have an estate tax. You New York people, I probably should have mentioned this earlier. I was strictly speaking based on the One Big Beautiful Bill, which is a federal bill. New York state has their own state estate tax, and there's and even that, you've probably heard of the estate tax cliff, which you
Yep.
have to be
Oh, yeah.
concerned about, because if you're under the exemption amount, great, which that trust in it by itself would be.
Yeah. What is
under
the cliff? What's the cliff in New York State? Is it the same as the Fed?
No, it's much less. It's I want to say it's 6, 7, 8. Man, if you give me a second,
Okay.
I can pull it up here.
Hey, don't go crazy.
Um,
I have a CPA working on this. I was just curious.
Phyllis Ann is on the call. She's an estate attorney. Phyllis Ann, you want to share?
So the 2025 exemption for New York State is 7,160,000. You fall off the fiscal cliff when your gross estate exceeds that amount by more than 5%.
Okay, that's good.
And when you fall off the cliff, it means you don't get that exemption at all. You lose
I
the entire
understand.
exemption.
Yeah.
And I think that number is 7.52 million.
Right. Roughly around that. Yep, exactly.
Yeah.
Thanks.
Yeah.
Phyllis
So
Ann.
this trust is going to be divided amongst like 11 beneficiaries. So I'm working with a CPA. So I'll any more information I can get, I'll get it through the accountant, and I appreciate the help.
Yeah, no, if you'd like us to look into it, feel free. I think Susan is going to give out my contact information.
Yes.
So if you do want another set of eyes, I'm happy to look
Sure.
into it. There are just a lot of other variables and questions and back and forth that we'd have to ask to get a full sense of the picture, and I don't want to
Yeah.
do that on this call, but
No, I get it.
appreciate it.
Thank you, Steve, for sharing that example. Anybody else? I don't see any other hands raised. No, looks like no one else. Anything else, Robert, you want to add, or anything else we haven't covered that we might want to share with the group?
No, Susan, offhand, I really can't think of any. I do think that these are, as I said earlier, these are real world issues that kind of slapped us in the face, and the end of the second quarter or early
Mhm.
third quarter. So it's it does raise awareness about some issues that can be acted on immediately. So it's not a 2026 event. And as John said, some of them are even more advantageous when it comes to planned giving in 2025. I think we leave off just saying that, as an organization, part of the private bank, these are conversations we have with clients. These are conversations we have with prospects, potential new clients. It's a lot of exciting stuff, and it really hits on a lot of the things that our client is seeking out of us. We like to share our knowledge, and clearly just me being on this call and listening to John to talk about this again just helps me better understand the tenets of the big, beautiful bill.
I think we have someone, I think it was Anne Marie, put something in the chat.
I saw the
you
question,
see it?
and it
If
really
you go over the
depends.
New York estate tax exemption, what percentage do you pay on the entire estate amount?
And the answer depends on how big the estate is. The top rate is 16%. It starts much lower than that. I'd have to just give me a second. But I think it starts at maybe it's around. I want to say around 4%. Maybe the other attorney on the call knows exactly off the top of her head, but I know it goes up to 16.
And what is the Fed rate when it goes over the Fed
That's
threshold?
a flat 40% every dollar,
Wow.
and there's no cliff,
Wow.
but it's a flat 40. Yep.
Oh my goodness.
Phyllis Ann, can you answer that? I don't know if you.
Yeah, that range is right. 16% is the highest and the lowest is around 4, depending upon the total gross estate.
Yeah, so I just pulled up the brackets, and it's 0 to 500,000, 3.06%, 500 to 1,000,000, 5 million to 1.5, 5.5, 1.5 to 2, 6.5, and there's a lot of brackets, but then over 10.1 million, it goes to 16%.
It's a good session, Susan.
Thank you. Well, I think also, and we've said it, and Robert has mentioned it as well on this call, that with the power lunches, you have to sit down and talk with advisors, but not only just one. And John and Robert, you tell me if I'm right. I mean, really, you talk to the estate attorney, but it's important to speak to your accountant, and if you have a financial advisor, and kind of work with them as a team. Because I know sometimes I know in my experience, I sometimes get so much out of my accountant, but then I can get more from my attorney, or financial person when I'm sitting talking to them.
You
and I
actually
kinda
need
put it all
a
together.
triage.
Right, exactly. Yeah, I think it
I-
really does help.
If I could just plug PNC for a second, because I've
Sure.
been here now out of private practice for 3 years, and I absolutely love working here. And one of the
It's nice.
great things about the private bank here is you get the full team. You get a portfolio manager like Rob. You get a legal and tax expert like myself, and a banking and credit expert, and also just a person that ties in the relationship and all the other resources that we have. But you get all that as a low, as low as $3 million, which is one of the lower minimums for a full private bank. And I just think it's a great amount of resources for kind of for less. So that's my plug for PNC. I'll leave it there.
We have Bob on the call. Bob, you want to say something about PNC?
No, thanks, Susan, for this opportunity. And thanks to Rob and to John for for sharing your knowledge base. We're here for any questions and opportunities to work with you and to work with St. John's. So thank you all for this opportunity.
No, I really appreciate it. When I reached out to Tom Califano, who's an alum of St. John's, who just recently retired from PNC, he's always been a great resource to me, and I've always been impressed with PNC. So I did turn to them and ask them if they would speak at one of my power lunches, and you guys were so nice and forthcoming, and I know you're busy, and to take time out of your schedule, it was great. And like I said, I really appreciate that. I hope everybody on this call feels like they know a little more about the big, beautiful bill or mega bill. When you're talking to people, hopefully you're more well informed with how it all works, and if there are some advantages there for you. As the director of gift planning, this is a busy time of year because everybody is making their charitable donations, and obviously, hopefully, anything that we've talked about on this Power Lunch, as well as last month's Power Lunch, hopefully that will help you make better decisions. Like John was saying, take advantage of some of these things. Maybe now's a better time to give, and to give a certain way than next year. I know many of you, some on this call, take advantage of the qualified charitable distribution if you're eligible for that, which is, getting money from your IRA direct transfer to the charitable organization. And that is a wonderful gift that's benefit to you as well as to the organization. Hopefully you'd want to give back to St. John's. So if you do decide on looking into a charitable trust or any other type of plan giving vehicle, I'd love to have that conversation with you. And when you make that gift, you become a member of the McAllen Society, which is a gift that gives back to you tenfold, because you're part of a wonderful community of alums or even non-alums that come together to support this wonderful institution of ours. And it offers a great social outlet. People make wonderful friends through this. They travel with us. There's just so many benefits. So if I've piqued your interest a little bit, please reach out to me. No pressure. No, I don't expect you to make any commitments right away, but at least we can have the conversation, and you'd be surprised what this gift can do for our students, for the school, and for yourself personally. So I thank you for your time. I also want to recognize that yesterday was Veterans Day. So anybody on this call or anybody going to listen to the recording, I thank all the veterans. God bless them for their service and bravery. We really appreciate it. And again, if there's any questions, I know it's probably all you're trying to take everything in. And then later on, you might say, oh, I wish I asked that question. If Luke, you can pull up that slide. We have my contact information and John's contact information that you can take down. And also Luke, my student associate, will be sending a follow-up email and you will receive the recording. We'll also send the recording from last month, and PNC is also including a handout, which I guess covers everything that we talked about today. Correct, John?
Much of it, yes.
Okay. All right, terrific. So, yeah,
I
think
will,
we're setting that up.
add
Thanks,
one
Luke.
last comment though, because
Yeah,
you
sure.
mentioned, you brought up qualified charitable distribution.
Oh, yes. Mm-hmm.
And while they're great form of great way to give money quickly, easily, very, effective. I caution people, please call your tax person, please call me before you do it, because I find that there are more tax efficient ways if you really want to get into it to
Mhm.
give, but they are a nice, easy way. I will say that.
Yes. Mm-hmm. Yes. Well, terrific. Thanks again, PNC, John and Robert and Bob. It was a pleasure working with you. And if I don't talk to any of you, I hope all of you have a very happy Thanksgiving to you and your family.